What's up, good people? How y'all doing? How y'all doing? Hey, you guys know what time it is. Hey, I'm 3 minutes late. Sorry, good people. Yeah, it's gonna be 25. It's gonna be 25. Hey, I was running down the stairs with a hot cup of coffee and I had to change shirts. All right. All right. Hey, so we're gonna see what it is. What's this gonna be today, good people? We're gonna see what these guys are talking about. Sorry for that. Yeah, man. No, I was running down the stairs and I was bloop. Oh my goodness. And I screamed. I sound like a 13-year-old schoolgirl watching a horror movie. Ah! If y'all only saw some of the stuff that goes on. Oh man, let's get to it. Hey, let me pull this up. Sometimes you gotta laugh at yourself, good people. Don't take yourself seriously. All right, let's pull up what's gonna happen today. There's a lot going on. We'll continue to talk about it. We got CNBC up right now. Let's pull that in. Let's listen for a minute.
We move into a period of austerity. So we were there from
All right,
1981
blah, blah, blah.
all the way to 1994. We have not been there since 1994. So we have low inflation.
So listen, before we get started, you guys know 20 free stock right now. You could do that right now before the earnings. Before the 25 basis interest rate hike. And then come join Stock Up You. This is sponsored by Stock Up You. This is my top link below. We got Stocks with Josh, Teaching Charting, Options by Keenan Grace, Dividend Investings by Mommy Trader, Basic Fundamentals by Stock Curry, and myself. All right, we got that in the way. All right, so let me go back to the talking heads because we want to be on point when they start, right? We just want to be, there we go. All right. Okay. And what happened here? All right. And I'm going to get to some, what would you say? It's never too late to drink coffee. That's right. That's right. Hey, can you guys hear me? Someone said we can't hear you, but everybody else can. Greetings, Costa Rica. Hey, I got to come to Costa Rica. I am starting a coffee brand. I want to. And Costa Rica probably will be one of the places that I visit. Okay, so it is 90% priced in that we will have a 25 basis point rate hike in about 9 minutes. Is that factual? Is that actually what's going to happen? We shall see. All right. There's been times when, things were priced in the market and we did not get it right. So let's see if, in fact, it will be. Hey, we got the Netherlands. All right. Hey, loud and clear. Thank you. Thank you so much. Yep. I try to have that radio voice. All right. So we're going to just chime right in. Let's talk about some things first, good people. Let's talk about this debt ceiling, right? Because we got 8 minutes. This debt ceiling. If you borrow money on a credit card, right? And you, let's say the credit card is due, you don't have all the money, right? Do you continue to spend at the rate that you're spending and don't do anything about paying the bill? Because that's where we are here in the United States with the debt ceiling. And I'm just going to say it. I'm an independent, so this is not about politics. There are just some basic things that everyone needs to follow the rules by, regardless of who's president and any of that. The powers that be right now, our president right now just wants to raise the debt ceiling and not curve the spending. All right. So we keep adding to the debt, but we don't want to curve what we're adding to the debt. And so what we do is we just keep raising the limit. I want to tell you guys and look you guys in the eyes and tell you, you and I will pay for it. We're already paying for it because we've had close to 15 years of free money, and we're paying for it now. And it's just not a good look. It's just not. We can't keep raising without. And so there is a lot going on at the same time that's really crazy. Now we're about to get hit, I believe, with another 25 basis points. And the banking industry is begging, please don't, please don't. We will see in a minute here. Let's see what they're talking about.
Solved this break with First Republic Bank. What we're learning is that it's not solved. This is going to be ongoing. And so as these banking...
All right, 7 minutes we got. Let me see what else is playing in the background here, because it is not lining up. All right, let me try this again. Let's see what's going on.
A sustainable strategy over the long term.
All right, that ain't sounding good. What's going on? Do I got another window open? All right, let's just try this again. We rebooted. Let's go, recession. A lot of people are waiting. A lot of people are waiting. We're just simply waiting for the hammer to drop and rip the Band-Aid off. Can you talk about Fed now? Yeah, that's what we're talking about it. It's actually finna come on live. The Fed decision is coming on live in a few minutes. And so we don't have to just talk about it. We're going to be about it. We're going to see exactly what's happening. All right. All right. So 25 basis points is baked in right now, good people. It is. The market, the slight sell-off that we had yesterday is signs that it is baked in. And they did a poll, and 90% of retail investors, you and I, we think that 25 basis points are coming. The question is will they stop there? Will they stop at this 25 basis point, or would they continue to raise or pivot? That's what the question is. Will they continue to raise or pivot or pause, right? And so that's what we want to see. What are they going to do, right? What are they going to do? Because it affects you and I. Let's check this audio again.
It's yours free for calling 1-800-213-5317.
Fisher Investments' disciplined approach will help see you through the market's ups.
Yeah, they ain't getting that free advertising from me. They got to take care of it. All right. We about to go down and hello, hey, how you guys doing? Recession blues. Yeah, I mean, we don't have the blues yet. The blues haven't even started in yet. Well, you got a heart beside that. So, all right, let's go to it.
Welcome now to Power Lunch as our special Fed coverage continues. I'm Tyler Matheson along with Kelly Evans. We're a few minutes away now, about 5 from the release of the Fed's statement.
Here's where markets are with just a couple of minutes to go. Dow's up 31 points. NASDAQ's up 56. It's leading the way with a 0.5% gain today. S&P's up 11 to 4130.
Market's not really leaning into the Fed here, one way or another, are they? Let's bring in our all-star Fed panel. We have Kristen Bitterly, Citi Global Wealth Head of North American Investments. Welcome, Kristen. And David Kelly, JP Morgan Asset Management Chief Global Strategist, and Jim Caron. He's Morgan Stanley's Investment Management Co-CIO of Global Balanced Funds. Jim, I'm going to begin with you.
So we got a few minutes. We got 3 minutes. I'm going to use them all. Listen, somebody's asking about the $5 a day. You got to understand it's not one size fit all. I'm not going to dodge the question or duck the question. My answer is going to be yet another question. Do you plan on being in this market for 5 to 7 years? If so, if you've been doing the $5 a day, then it depends on what stock you're in. If it's all big tech stock, you can actually do a little profit taking if you want to. But if you believe in them longer term or long term, then continue to DCA. Me, myself, this is not get like me. Anything I say is not a suggestion to buy, hold, or sell. I haven't done anything with my $5 a day. I haven't done any profit taking with that portfolio. I have that in a whole different portfolio. I have mine in Fidelity, right? So I'm doing $5 a day, but it's more than $5 a day. But I'm dollar cost averaging but I've been doing it for a couple of years now. And I plan on not stopping for a minimum of another 7 years. That's just me. So you have to look at what type of stock you're in. If you're up 50%, then, and you think we're going into a recession, you can afford to take some profits. All right. That's up to you. But I can't tell you because I don't know what you're in. I can't look at your portfolio. All right. Audio's good. Thank you. Bank's going to break. You know, we shall see. You know, they literally settled this on a weekend to make sure that this banking situation. So our government cut a deal with JP Morgan and they changed the rules just so JP Morgan can save the banking industry. You guys know how this goes. Every time before the Fed talks, we have a spike in the major indices, the Dow, S&P, and the NASDAQ, right? You'll see them come up here. That happens all of the time, right? And then if there's bad news, it starts to tank. But let's look at this. Look at the 2 and the 10. Still, if you're getting paid more for a 2-year than a 10-year, then that's a sign that a deeper recession or recession is coming. It's coming. When? Nobody knows exactly, but it is coming. All right. And so as we could see, Dow is up 45. Everything is green, but it's flat. You know, it's hard to tell what the Fed is going to do. We'll see. We'll see. What do you think about Marriott Vacation stock? I got in and out of those plays and kind of got out at the top, and travel and leisure are going to be good. We have this revenge travel thing going on, and I don't believe it's going to stop yet. But eventually you have to take profits. Hotels, for me, and oil are never long-term investments. They're swing trades. Now, it may be months that I hold them, but they're swing trades. Okay, let's go to it and see what they're talking about.
The sticky inflation, but also the need to say that there's enough hikes in the pipeline already at the moment that it'll probably do the job for it. It doesn't need to do any more than this.
And we should remind everybody that we won't get the projections or the dots as they're called today. So a little bit less information than we've had in some other meetings. And that said, it's always, the statement, the language in the statement, and then the press conference with Chair Powell. David, I guess there's some questions about whether they'll, use the word yet in their statement to kind of indicate some flexibility about rate hikes or not here. And we'll come back to you in just a moment.
Because Steve Leisman has the Fed decision here in just a couple of seconds' time. Will it be that quarter point or something different? Steve.
Federal Reserve raising by 1/4 point, bringing the funds rate up to a range of 5 to 5.25%. The Federal Reserve offering, I guess I would call it strange, somewhat hawkish forward guidance that's less hawkish than the last time around. The Fed saying it is determining whether additional policy firming may be appropriate. That's a change from the prior language that it removed, where it said it anticipates that some additional policy firming may be appropriate. So maybe one way to think about this is it's gone from being pretty sure it's going to hike to maybe it will hike, but it's really looking for a reason to do so. Again, I'm going to repeat that. It's gone from the Fed now saying it is determining whether additional policy firming may be appropriate, taking out language saying that it anticipates that firming will be appropriate. The U.S. banking system, the statement says, is sound and resilient, but tighter credit conditions are likely to weigh on households. The extent and effects of that remain uncertain. Inflation remains elevated. The committee, it says, remains highly attentive to inflation risks. On the economy, just a couple lines. Economic activity expanded at a modest pace. Job gains have been robust, unemployment low, and inflation elevated. So back to you guys to chew over what that statement means. Is it a pause? Is it I don't know what it is, guys. Back to you.
Was it a unanimous vote, Steve?
It was absolutely a unanimous vote. Yes, good question, Donna.
All right.
Yeah, because we actually had some discussion from former Fed officials saying if they continued to hike, they might pause. Eric Rosengren was one of those people. On your screen is a board of the regional banks, which are still in the green. Obviously, First Republic excepted from that, although the gains are modest. PNC up about 0.1%, U.S. Bank up 1%, M&T a little less than 3%. Let me bring in Bob Bassani and Rick Santelli for some quick blush market thoughts here. Bob, what do you see?
Well, look, it's the phrase determining whether additional policy firming may be appropriate is different than saying some additional policy may be appropriate. That's a lot more indeterminate, and the S&P moved up slightly on that. And so, look, the question is, the market was positioned for a hawkish hike, meaning the Fed's going to raise rates, indicate inflation's coming down, but it's still too high, and will hike again if needed. What would make the market go up is any kind of a dovish hike. The dovish hike would be, okay, we've had some progress on inflation being made, the bank crisis is slowing lending, and implying somehow they're uncertain about how much more they want to hike. And to that extent, I think this satisfied a little bit of that. What makes this really hard to figure out is just this whole impact of the banking crisis on tighter financial conditions. That seems to be the real issue here. So this bank thing is more from deposit flight into something bigger, about more regulation coming, about tighter credit conditions, particularly in commercial real estate lending. So I think that's really what the market wants to hear. They want to hear that the banking crisis is causing the Federal Reserve to be additionally more cautious than they normally would be. They want to know that the rest of the year nothing is going to happen. And that's, I think, why the market's holding up. The market doesn't want to believe in the hard landing. They want to believe that growth is holding up, their earnings are not getting slashed. That's what we're seeing, but it's all dependent on how the Fed is approaching the second half of the year. So we want to hear more about that bank.
I buy into that, but so the short answer is yes, Tyler. And as you look, 2-year note yields have dropped 3 or 4 basis points. 10-year are fairly steady. Fed fund futures, as referenced by January of next year, has moved up just a smidge. Here's the way I would frame it to try to keep it quite simple.
Sorry, good people. I know you couldn't hear me. I had this on mute. So listen, 25 basis points is what we have. The Fed actually muted what he anticipates for the future. He literally didn't say anything. He changed his language on purpose. This is one of the tactics that Jerome Powell does use, right? And he's very careful. Now, a lot of people were skeptical and thought maybe he would say 25 now and start talking about, I thought he would, if necessary, he would. He really did just say that without saying it, okay? This is the way Jerome Powell masterfully plays this, because what he says, 90%, there was a 90% chance already baked in for him to go up 25 basis points. That was already baked in. The market absorbed that. It reacted yesterday, right? And he knew that. So if he would have been hawkish and said, we think we're going to have to go up another 25, 50, or we need to continue to go up 25 until further notice, the market would have tanked, okay? And he knows that. So what he did was he gave us a nothing statement. He literally said that if necessary, he would, but he said it without saying it. So now look at the indices. Still flat, right? That's a flat. Actually, I would call this a win for the bulls if you ask me, okay? Yeah, I know the sound was out. It's in now. I'm sorry, good people. I had the mute button on. So we could see what's going on, right? Let's go here to Moo. As you could see here, Federal Reserve raises key U.S. interest rates by 25 basis points of 5.0% to now 5.25 percentile. Okay, percentile. See there? That's what happens when you try to use big words. All right. But there we have it. The Dow was actually fighting back to get to exactly where it was pre-announcement. It's pretty muted, pretty flat. All right. Hey, you guys still can't hear me? Can you hear me? Right? I know I had that on, but can you guys still hear me? Okay. All right. Sorry about that, good people. But that is what I wanted you to see. Look, as you could see, well, it'll come back. As you could see, the market literally did not freak out like it normally does when the Fed is talking. No raise, no fall. It was very, very, very minimal. Okay. So I'll take today. I'll take it. I think that was a good move. All right. So let me show you guys this. How can I pause this? All right. Let's see when they go back to the bonds. Okay. For those of you that don't know about the bonds, When you get paid more yield on a 2-year bond than a 10-year bond, that's what's called an inverted yield curve. And that's a sign that a recession is yet to come. Well, that's what it is right now. You're right. So as we can see, banks are starting to rebound a little bit. Wells Fargo is up, PNC, everything is actually up today. Whether it be regional banks or big banks, they are up. All right. So that's good, right? We'll take it. We will take it. All right. Hey, good people, tonight, myself, Stock Mo, and the guys will be on. Myself, Keenan Grace, Stocks with Josh. See how I'm getting tongue twisted? We will all be on live tonight. And I want you guys to join me, because I want you guys to be in on the conversation that we're going to have, right? And we're going to be talking about what is going on, not just what I think, but what these gentlemen think as well. And I think that is well worth you guys coming in and look. See here, that will be 7 o'clock, 7 p.m. Eastern Standard Time. And that will be 6 o'clock Midwest time, okay? And you guys know 4 o'clock from you guys out there in California, where the ground shakes. All right, I'm not getting back into that again. All right, good people. So let me answer a few questions. Okay, yep. What time tonight? That will be 7 p.m. Eastern time, 7 p.m. New York time. That's 6 p.m. Chicago time. And that's 4 p.m. LA time. Okay, so wherever you fall in that spectrum. So just make sure you guys get the notification bell and come join us. I'd like to have my followers over there too as well. Okay, any thoughts on SoFi? Actually, I started to Mo Curly and Larry. I knew it was coming, man. It's not the first time, right? Oh my goodness. Okay, so market will move on Apple earnings. Yeah, I believe the market will move on Apple's earnings. I do believe so. Let's look at big tech really quick. All right, let's look at big tech and see what big tech is doing, because I want to discuss that for a minute with you guys. Big tech. And I understand why a lot of people are asking AAPL. I understand why a lot of people are asking, hey, should you take profits? And I want you guys to make that determination for yourself. Let's look at this. Apple, Microsoft, Amazon. Okay. Let's throw Alphabet in there. And then we'll A and B between Tesla and let's throw... I'm going to leave Tesla out. I'm going to put NVIDIA in there, right? And guys, you guys follow me with this, okay? So here's what I want you to look at. This month, these are up nicely, right? Year to date, okay? Year to date, look at NVIDIA. Look at NVIDIA year to date. 95%, Apple up 35%. Microsoft, 28. Alphabet is the least of them, okay? And then if we A and B Tesla is up 51%. Look at Tesla and NVIDIA. NVIDIA at the bottom, 95%. Tesla, 51%. Year to date, okay? All right, we're 4 months in, right? January, February, March, April, May. We're in May now, 5 months in, right? And so I ask you, do you think that big tech is too frothy? Frothy meaning top heavy, meaning expensive. I ask you the question, do you think so? If you think that a deeper recession is coming, then your answer will probably be yes. Now, I can't tell you to sell your stock. I can't do that, right? But I could tell you this. You never have to apologize or ask permission to take profits. You don't have to sell all of your stock. You know, you can use stop losses on some of your big tech if you want to. Remember, this is not one size fit all. If you came in and you said, hey, I'm going to DCA for the next 10 years, then that's what looks good for you. All right. But I just want to just give some information that tech, big tech, is a little frothy right now in a bear market with a looming deeper recession. Now, here's the challenge. The money that you were putting in, you should still be putting into your broker, right? So when and if, should I say, if and when we have another leg down, then I challenge you to go back in, okay? Now, some people think October lows of last year were the lows. If you think that was the lows, then you want to hold, that's up to you. But remember, anything I say is not a suggestion to buy, hold, or sell. I'm just trying to get you to think, okay? All right, how long we been? 26. Do you recommend taking profits on long-term investments? Yep, I just went over that. Everything I just said, I want you to carefully consider what I just said. Never feel bad about taking profits. Yep. Never feel bad about taking profits. The decision was 25 basis points, and he muted his comments about the future hike rates. So he was not hawkish, right? For those of you, when you hear the terms hawkish and dovish, a hawk is aggressive, right? And a dove is meek. So he didn't come out aggressive, hawkish, okay? Yep. Stock up you. Gilbert, if you like stock up you, listen, good people. If you really, really, truly want to learn this market, I'm just telling you guys that I have put together a course where everyone can understand it. Everyone can understand it. That's why I call it the ultimate beginner's course. Now, don't get fooled by the ultimate beginner's course, because you will also learn how to read charts, how to know when to buy and sell a stock. You will also know how to learn as a beginner what is options and how you can make money, okay? And then you'll know how to qualify a stock with basic fundamentals. Stock Curry and myself teaching basic fundamentals. And you will understand and make money with dividends, learning from Mommy Trader about how to invest where you can simply make money off of the dividends, okay? And so that is all. I literally have it the cheapest price out there, right? Yeah, Chicken Genius is still holding. Good for Chicken Genius. I like Chicken Genius. I probably only seen one of his videos this year, but I like Chicken Genius. I don't agree 100% with anybody. I don't agree 100% with me, Kevin, Stock Mo, Keenan Grace, Stocks with Josh, and none of them agree 100% with me. That's the beauty of this. That is the beauty of it. Okay. So, yep. I'm going to see what's going on here with what's going on. Yeah, the Fed statement. I might just, I'm thinking that, I might just come back tonight with the guys and then discuss what he says, because sometimes he talks for a short period and then sometimes he goes on and on and on and on and on. It's better to day trade or long term. Right now in a bear market, this is going to sound so. Right now, I'm swing trading. So you call it day trading, I call it swing trading. That doesn't mean that you need to be doing everything daily. I'm swing trading, as you guys see. I rarely get into a play. If I think there's money to be made, I'll get in and I get right back out. and I'm holding my cash, right? So that's what I do, okay? But because I expect a shift, I expect a big shift in the market. That's what I do. Now, it may be wrong, it may be right. I don't have a crystal ball, okay? And my last name is not Pelosi. So that's where I am right now. But if you think that we are near the drain or near the bottom, like let's say if we were getting close back to where we were in October lows, then I would be buying long term. I literally would be loading up long term. And the truth be told, that's what I'm waiting to do. So for instance, okay, let's go right here. So let's go to the Dow. Actually, let's go to the S&P, right? It's S&P 500, good people. All right. Now, let's go back to October lows, right? So here are October lows, right? Let's get rid of that. So if we get back around to where the S&P is down to about 3,500-ish in that range again, I'm buying. And I don't care if it goes down to 34, 33, 32. At some point, you got to find a point where you feel that the market is not at the bottom, but it's in a range where you can make money long term. So when the market gets down that low again, I'm not going to be just buying to swing. Now, there'll be some swing trades I'll be in, but I'm going to be buying to hold long term. And I challenge you guys to make it a stock that you want to hold for a generation. I challenge you guys to have some blue chip companies in there, because the truth of the matter is when we go into a deeper recession and a true hard recession, the stock, big tech will get spanked. So those are the ones with the high PEs, the expensive stock. Those are the ones that's going to drop the most. And those are the ones that I want to load up on. So if you're trying to rebalance your boat and really be a long-term investor and build generational wealth, then when it falls down there, if you don't know what stock to pick, just get VOO. Just get VTI. Just get the top 500 companies. Just buy the overall stock market, because over a period of 10 years, that's going to outperform your stock picking. This is the truth if you want to really gain generational wealth. Just remember that. Just remember what I just showed you. For those of you that don't know, if we get down low beneath 3,500, the lower we go, the heavier I'm going to buy. And you say, hey, I don't have any money for that right now. Then I suggest you start saving money right now. I suggest that you create a side hustle right now, because this does not represent fear. It represents favor, in your favor. There's a song by Fred Hammond. He's going to work it out. It's going to work in your favor. This is when it works for your favor. This is when being prepared is an opportunity, okay? But we got to do the work. We got to study, be ready, and do the work. I'm going to keep telling y'all, even in a bear market, that the greatest transfer of wealth in the history of the world is happening now. But the question is, like the old commission song, will you be ready? Will you be ready? All right. All right. Hey, how you guys doing? So we got Elizabeth Warren on here, bumping gums, as you could see. I ain't gonna lie, y'all. Something about her that gets on my nerves, just work my nerves. I don't know if it's her voice or whatever. I don't know. I try not to be that person that just don't like people that you just don't like them based on the way they look or sound. That's wrong, y'all. Y'all pray for me. But I can't do her, man. I just can't do her. And then some of her thoughts are just ridiculous. You guys know that. All right. And same thing. There's some Republicans. As soon as I see them, I go, oh my God. Not today. Oh, it's a good question. Boris, it's a great question. Here, let's answer this question. Boris said, what percentage of your portfolio is VOO? I will tell you, if I get in somewhere near the bottom-ish, because no one knows where the bottom is, and I'm going to make a bold statement. Right now in this season, in 2008, it was VTI. But right now for me, it's VOO. And I will tell you that if I drew a pie, VOO will be 50%, 50%. This is what I'm doing. I'm just staying. Yeah, there's going to be some other stock in my other portfolios that I think that will 2x, 3x, will just bounce, 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 bounce. I know that, but not over a period of 10 years. And so half of my portfolio will be VOO. That's me, okay? And for those of you that are trying to figure out which one should you do, VOO, VTI, blah, 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 let me share with you guys this. I just want you guys to see this, all right? Here we got VTI, which is Vanguard, right? VTI, for those of you that don't know, the overall stock market, okay? About 3550, okay? That's how many, all right? And then let's compare that to VOO. Now watch this. I want to show you guys this. All right, so we're going to compare that to VOO, which is another Vanguard. So now you have the overall stock market and the top companies, all right? Top 500 companies. Look at what they've done in the last year. They dance with each other. They literally dance with each other. Look at what they've done over the last 5 years. Look at that. In lockstep, they dance with each other, right? And so one is 49, one is 55, right? Look at Max, right? Look at that. They dance with each other. So what I'm saying to you guys is, it really doesn't matter. Just get one or the other, okay? So what I'm gonna do, good people, is, let's see. Is he gonna talk? I'm gonna hang around for a little bit longer. That's what I'm gonna do. As we can see, the Dow is fighting its way back. Look at that, 770. See here? Yep. So I should have listened to you, Uncle Larry got burned on. Oh, I'm sorry to hear that, man. I'm sorry to hear that. Yeah, I did earlier, but then I made money back by doing what I suggested. Yeah. And Kenneth, I'm going to tell you, I'm going to tell you, the lessons are learned in the losses. I'm going to just say this. The lessons are learned in the losses, man. FRC burned me. First Republic, I've got burned earlier. Then I learned, and then I studied. I stopped trading, and then I saw what was going on, and I told you guys Friday, the First Republic earnings was Monday. I told you Friday exactly what was going to happen to it, and it did exactly what I said. So we made money going up, and then we made money going down. But the fact that you know it and verbalize it, you're going to be okay. You're going to be fine. You're going to make your money back. Yep. Kenneth, you're going to make your money back. And here's one of the things I do want to tell you guys. Whenever you lose in a stock, and this is one of my lessons in my course. Whenever you lose in a stock, control your mind. Because what we try to do is we try to get even. It's like little kids. Somebody hit you, and then you're not trying to hit everybody else on the play lot. You're trying to get the person back. You chasing to get the person back that hit you. This is going to sound crazy. What I've learned is, no. You swing on the first person that's near you. Now I know this sounds crazy, but hear me out. If you lose money in First Republic, your mind says, I have to make my money back in that stock. That is a trap. That's a bull trap, okay? And what happens is the stock is falling and you trying to do a call on it, and then the stock starts rising and you're trying to do a put on it, and you lose money, and then you hold it and it goes lower, and then you keep holding it and it goes lower, there's opportunity somewhere else. You have to cut your losses and move somewhere else and see where there's opportunity to make money with less risk. Limit your risk, right? Part of being a good investor or trader is managing your risk. So hopefully that helps you. So look for opportunity elsewhere. Houston in the house. I'm cool. All right, Michael Williams. Yes, sir. Yeah, Eli Lilly is doing good because they have a drug that deals with Alzheimer's, and it's actually doing good. Eli, where is that? Yeah, Eli Lilly is doing very well based on these drugs for Alzheimer's, okay? But then just think about this. Just think about what other company is working on Alzheimer's, okay? What other company is working on a drug for Alzheimer's? Because there will be sympathy plays where other stock will raise as well. That always happens. So do your research on that, family. It looks like he's close. Fed raises funds rate. Let's see what's going to happen. Oh, let's see. Fed determining whether additional firming may be appropriate. Well, we'll see. All right, what else we got here? You got out early? The question is, did you make a profit? So if you made a profit, then you didn't get out too early. That's another trick. Let's say a stock goes up 50% and you tapped out at 40%. You made the right move, because if you keep looking at the extra 10% that you didn't make, you're setting yourself up to lose time after time. I'm just telling you. I am absolutely telling you. I've been doing this a long time. Fall of the dollar. Man, that's a whole show. I'm going to make a whole show on the fall of the dollar, but we first got to explain what's happening with the dollar. All right, let's go, good people.
Warren, thank you so much for being with us. We appreciate your time. Here is Jay Powell.
Before discussing today's meeting, let me comment briefly on recent developments in the banking sector. Conditions in that sector have broadly improved since early March, and the U.S. banking system is sound and resilient. We will continue to monitor conditions in the sector. We're committed to learning the right lessons from this episode, and will work to prevent events like these from happening again. As a first step in that process, last week we released Vice Chair for Supervision Barr's review of the Federal Reserve's supervision and regulation of Silicon Valley Bank. The review's findings underscore the need to address our rules and supervisory practices to make for a stronger and more resilient banking system, and I'm confident that we will do so. From the perspective of monetary policy, our focus remains squarely on our dual mandate to promote maximum employment and stable prices for the American people. My colleagues and I understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised its policy interest rate by 1/4 percentage point. Since early last year, we've raised interest rates by a total of 5 percentage points in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. We are also continuing to reduce our securities holdings. Looking ahead, we'll take a data-dependent approach in determining the extent to which additional policy firming may be appropriate. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy slowed significantly last year, with real GDP rising at a below-trend pace of 0.9%. The pace of economic growth in the first quarter of this year continued to be modest at 1.1%, despite a pickup in consumer spending. Activity in the housing sector remains weak, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. The labor market remains very tight. Over the first 3 months of the year, job gains averaged 345,000 jobs per month. The unemployment rate remained very low in March at 3.5%. Even so, there are some signs that supply and demand in the labor market are coming back into better balance. The labor force participation rate has moved up in recent months, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. But overall, labor demand still substantially exceeds the supply of available workers. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in March, total PCE prices rose 4.2%. Excluding the volatile food and energy categories, core PCE prices rose 4.6%. Inflation has moderated somewhat since the middle of last year. Nonetheless, inflation pressures continue to run high, and the process of getting inflation back down to 2% has a long way to go. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a quarter percentage point, bringing the target range to 5 to 5.25%. And we're continuing the process of significantly reducing our securities holdings. With today's action, we have raised interest rates by 5 percentage points in a little more than a year. We are seeing the effects of our policy tightening on demand in the most interest rate sensitive sectors of the economy, particularly housing and investment. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In addition, the economy is likely to face further headwinds from tighter credit conditions. Credit conditions had already been tightening over the past year or so in response to our policy actions and a softer economic outlook. But the strains that emerged in the banking sector in early March appear to be resulting in even tighter credit conditions for households and businesses. In turn, these tighter credit conditions are likely to weigh on economic activity, hiring, and inflation. The extent of these effects remains uncertain. In light of these uncertain headwinds, along with monetary policy restraint we've put in place, our future policy actions will depend on how events unfold. In determining the extent to which additional policy firming may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We will make that determination meeting by meeting based on the totality of incoming data and their implications for the outlook for economic activity and inflation. And we are prepared to do more if greater monetary policy restraint is warranted. We remain committed to bringing inflation back down to our 2% goal and to keep our longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thanks, Gina.
Hi, Gina Smilik, New York Times. Thanks for taking our questions. I wonder if you could tell us whether we should read the statement today as a suggestion that the committee is prepared to pause interest rate increases in June. And I also...
Here comes the gotcha questions. Watch the markets on the lower right-hand corner.
From the March minutes, and if so, what a recession like what they're envisioning would look and feel like when it comes to, for example, the unemployment rate.
So, taking your question, of course, today our decision was to raise the federal funds rate by 25 basis points. A decision on a pause was not made today. You will have noticed that in the statement from March, we had a sentence that said the committee anticipates that some additional policy firming may be appropriate. That sentence is not in the statement anymore. We took that out, and instead we're saying that in determining the extent to which additional policy firming may be appropriate to return inflation to 2% over time, the committee will take into account certain factors. So that's a meaningful change that we're no longer saying that we anticipate. And so we'll be driven by incoming data, meeting by meeting, and we'll approach that question at the June meeting. So the staff's forecast is so. Let me start by saying that that's not my own most likely case, which is really that the economy will continue to grow at a modest rate this year. And I think that's so different people on the committee have different forecasts. That's my own assessment of the most likely path. Staff produces its own forecast, and it's independent of the forecasts of the participants, which include the governors and the Reserve Bank presidents, of course. And we think this is a healthy thing, that the staff is writing down what they really think. They're not especially influenced by what the governors think, and vice versa. The governors are not taking what the staff says and just writing that down. So it's actually good that the staff and individual participants can have different perspectives. So broadly, the forecast was for a mild recession, and by that I would characterize as one in which the rise in unemployment is smaller than has been typical in modern era recessions. I wouldn't want to characterize the staff's forecast for this meeting. We'll leave that to the minutes, but broadly similar to that.
Rachel.
Thank you, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. I'm wondering if you can talk about the account of possible effects of a debt limit standoff. You've said repeatedly that the ceiling must be raised, but do you see any economics effects of even getting close to a default, and what type of situation would that look like?
So I wouldn't want to speculate specifically, but I will say this. These are fiscal policy matters, for starters, and they're for Congress and the administration, for the elected parts of the government to deal with, and they're really consigned to them. From our standpoint, I would just say this. It's essential that the debt ceiling be raised in a timely way so that the U.S. government can pay all of its bills when they're due. A failure to do that would be unprecedented. We'd be in uncharted territory, and the consequences to the U.S. economy would be highly uncertain and could be quite averse. So I'll just leave it there. We don't give advice to either side. We just would point out that it's very important that this be done. And the other point I'll make about that, though, is that no one should assume that the Fed can protect the economy from the potential, short and long-term effects of a failure to pay our bills on time. It would be so uncertain that it's just as important that we never get to a place where we're actually talking about or even having a situation where the U.S. government's not paying its bills.
And just to follow up, was discussion around the uncertainty of a possible standoff, did that affect today's monetary policy decision at all?
I wouldn't say that it did. It was, of course, it's something that came up. We talk a lot about risks to the outlook, and that come up. A number of people did raise that as a risk to the outlook. I wouldn't say that it was important in today's monetary policy decision yet.
Steve.
Mr. Chairman, thank you. Yeah, Steve Leisman, CNBC. Can you tell us what the Federal Reserve Board did in the wake of that February presentation where you were informed that Silicon Valley Bank and other banks were experiencing interest rate risks? And can you tell me what supervisory actions you've done in the wake of the recent bank failures to make sure that banks are currently appropriately managing interest rate risk? And kind of part three, but it's all the same question here. Do you still think this separation principle that monetary policy and supervision can be handled with different tools? Thank you.
Sure. So the February 14th presentation, I didn't remember it very well, but now, of course, I've gone back and looked at it very carefully. I did remember it. And what it was a general presentation. It was an informational briefing of the whole board, the entire board. I think all members were there. And it was about interest rate risk in the banks and lots of data. And there was one page on Silicon Valley Bank which talked about the amount of losses mark-to-market losses they had in their portfolio. There was nothing in it about that I recall anyway about the risk of a bank run. So it was. I think the takeaway was they were going away to do an assessment, a horizontal assessment of banks. It wasn't. It wasn't presented as an urgent or alarming situation. It was presented as an informational, non-decisional kind of a thing, and I thought it was a good presentation, and as I said, did remember it. In terms of what we're doing, of course, I think banks themselves or many banks are now are attending to liquidity and taking opportunity now, really since the events of early March to build liquidity. You asked about the separation principle. Like so many things, it's very useful. But ultimately, it has its limits. I mean, I think in this particular case, we have found that the monetary policy tools and the financial stability tools are not in conflict. They're working well together. We've used our financial stability tools to support banks through our lending facilities, and at the same time, we've been able to use our monetary policy tools to foster maximum employment and price stability.
Mr. Chairman, I'm sorry. I don't mean to be argumentative, but the staff report said SVB has significant interest rate risk. It said interest rate risk measurements failed at SVB, and it said banks with large unrealized losses face significant safety and soundness risk. Why was that not alarming?
Well, I mean, I didn't say it wasn't alarming. It was they're pointing out something that they're working on and that they're on the case. That I'm not sure whether they mentioned. I think they did actually. They mentioned that they had taken regulatory action, or supervisory action in the form of matters requiring attention. So I think that was also in the presentation. I think it was to say, yes, this is a bank, and there are many other banks that are experiencing these things, and we're on the case.
Thank you.
Go to Victoria.
Hi, Chair Powell. I wanted to ask, obviously, with the recent bank turmoil, we've seen multiple banks buy other banks, and I was just curious whether you think that further consolidation in the banking sector would increase or decrease financial stability, and whether you have any concerns about the biggest bank in the U.S. Getting even larger.
So, we certainly don't, and I don't have an agenda to further consolidate banks. Consolidation has been a factor in the U.S. banking industry really since interstate banking, and before that even. It goes back more than 30 years. When I was in the government a while back, I think there were 14,000 banks. Now there are 4,000 and change. So that's going on. I personally have long felt that having small, medium, and large-sized banks is a great part of our banking system. The community banks serve particular customers very well. Regional banks serve very important purposes, and the various kinds of GSIBs do as well. So I think it's healthy to have a range of different kinds of banks doing different things. I think that's a positive thing. Is it a financial? So I would just say, in terms of J.P. Morgan buying First Republic, the FDIC really runs the process of closing and selling a closed bank completely. That is their role, so I really don't have a comment on that process. As you know, there's an exception to the deposit cap for a failing bank. So it was legitimate, and I think the FDIC, I believe, is bound by law to take the bid that is the least cost bid. So I would assume that's what they did.
So, but do you have any concerns about the fact that they're getting larger in general?
So I think it's probably good policy that we don't want the largest banks doing big acquisitions. That is the policy, and but this is an exception for a failing bank, and I think it's actually a good outcome for the banking system. It also would have been a good outcome for the banking system had one of the regional banks bought this company, and that could have been the outcome. But ultimately, we have to follow the law in our agencies, and the law is it goes to the least cost bid.
Colby. Thank you. Colby Smith with the Financial Times. At the March meeting, you mentioned that a tightening of credit conditions from the recent bank stress could be equal to one or more rate increases. So given developments since then, how has your estimate changed?
Yeah, I think I followed that up by saying it's quite impossible to have a precise estimate of the words to that effect. But in principle, that's the idea. You know, when we've been raising interest rates, and that raises the price of credit, and that, in a sense, restricts credit in the economy, working through the price mechanism. And you know, when banks raise their credit standards, that can also make credit tighter in a kind of broadly similar way. It isn't possible to make a kind of clean translation between one and the other, although firms are trying that, and you know, we're trying it. But ultimately, we have to be honest and humble about our ability to make a precise assessment. So it does complicate the task of achieving, you know, a sufficiently restrictive stance. But I think conceptually, though, we think that interest rates, in principle, we won't have to raise rates quite as high as we would have had this not happened. The extent of that is so hard to predict because we don't know how persistent these effects will be. We don't know how large they'll be and how long they'll take to be transmitted. But that's what we'll be watching carefully to find out.
Just to quickly follow up, what does it suggest about the scope for the committee to pause rate increases perhaps as early as next month, even if the data remains strong then, if it's having some kind of substitute effect?
This is just something that we have to factor in as we want to find ourselves. So I guess I would say it this way. The assessment of the extent to which additional policy firming may be appropriate is going to be an ongoing one, meeting by meeting, and we're going to be looking at the factors that I mentioned that are listed in the statement, the obvious factors. That's the way we're going to be thinking about it. And that's really all we can do. As I say, it does complicate. We have, a broad understanding of monetary policy. Credit tightening is a different thing. There's a lot of literature on that, but translating it into rate hikes is uncertain. Let's say it adds even further uncertainty. Nonetheless, we'll be able to see what's happening with credit conditions, what's happening with lending. There's a lot of data on that, and we'll factor that into our decision making.
Howard.
Howard Schneider with Reuters. Thank you. So noting that the statement dropped the reference to sufficiently restrictive, I was wondering, given your baseline outlook, whether you feel this current rate of 5 to 5.25% is in fact sufficiently restrictive.
So that's going to be an ongoing assessment. We're going to need data to accumulate on that. Not an assessment that we've made. That would mean we think we've reached that point, and I just think it's not possible to say that with confidence now. But nonetheless, you will know that the summary of economic projections from the March meeting showed that at that point in time that the median participant thought that this was the appropriate level of the ultimate high level of rates. We don't know that. We'll revisit that at the June meeting, and that's we're just going to have to, before we really declare that, I think we're going to have to see data accumulating and make that, as I mentioned, it's an ongoing assessment.
And a follow-up on credit, if I could you give us a sense of what the SLOOS survey indicated? It was already, I think 45% of banks were tightening credit as of the last survey. What did this one show, and how did that weigh into your deliberations?
So we're going to release the results of the SLOOS on May 8th, in line with our usual time frame. And I would just say that the SLOOS is broadly consistent when you see it with how we and others have been thinking about the situation and what we're seeing from other sources. You will have seen the Beige Book and listened to the various earnings calls that indicate that mid-sized banks some of them have been tightening their lending standards. banking data will show that lending has continued to grow, but the pace has been slowing really since the second half of last year.
Let's go to Nick.
Nick Tamaros of the Wall Street Journal. Chair Powell, the argument around the end of last year and the beginning of this year to slow down the pace of increases was to give yourself time to study the effects of those moves. After the bank failures in March, as you've discussed, the Fed staff projected a recession starting later this year. So my question is why it was necessary to raise interest rates today, or put differently, if the whole point of slowing down the pace was to see the effects of your moves, and now you've, for the last two meetings, been seeing the effects of those moves, why did the committee feel it was necessary to keep moving?
Well, the reason is that we, again, with our monetary policy, we're trying to reach and then stay at for an extended period, a level of policy stance that's sufficiently restrictive to bring inflation down to 2% over time. And that's what we're trying to do with our tool. I think slowing down was the right move. I think it's enabled us to see more data, and it will continue to do so. So we really we have to balance. We always have to balance the risk of not doing enough and not getting inflation under control against the risk of maybe slowing down economic activity too much. And we thought that this rate hike, along with the meaningful change in our policy statement, was the right way to balance that.
And just to follow up, what you said in response to Howard's question, you'll need data to accumulate to determine if this is a sufficiently restrictive stance. Does that data need to accumulate, or could it accumulate over a longer period than a 6-week intermeeting cycle?
As I mentioned, I would just say that this assessment will be an ongoing one. You can't, with economic data, you can't. You've seen take inflation from it. Look back. We've seen inflation come down, move back up 2 or 3 times since March of 2021. We've seen inflation have a few months of coming down and then come right back up. So I think you're going to want to see that that a few months of data will persuade you that you've got this right, kind of thing. And we have the luxury. We've raised 500 basis points. I think that policy is tight. I think real rates are probably that you can calculate them many different ways, but one way is to look at the nominal rate and then subtract a reasonable estimate of let's say 1-year inflation, which might be 3%. So you've got 2% real rates. That's meaningfully above what many people anyway, would assess as the neutral rate. So policy is tight, and you see that in interest-sensitive activities, and you also begin to see it more and more in other activities. And if you put the credit tightening on top of that and the QT that's ongoing, I think you feel like we may not be far off, or possibly even at that level.
Thank you, Edward.
Thank you very much, Chair Powell. Edward Lawrence with Fox Business. So if the Federal Reserve gets down to the 3% inflation, as the projections show at the end of this year, or close to it, would it be okay for you for a prolonged period of 3% inflation and hoping for some outside event to move down to 2% target?
I think we're always going to have 2% as our target. We're always going to be focusing on getting there.
But would you be okay with a prolonged 3%? Let me just say that's not what we're looking for. We're looking for inflation going down to 2% over time. I mean, that's not a question that's in front of us, and it would depend on so many other things. But ultimately, we're not looking to get to 3% and then drop our tools. We have a goal of getting to 2%. We think it's going to take some time. We don't think it'll be a smooth process, and I think we're going to need to stay at this for a while. How does the other side of the mandate, the jobs side, once you get to 3%, going from 3 to 2, how does the other side of the mandate balance?
I think they will both matter equally at that point. Right now, you have a labor market that's still extraordinarily tight. You've still got 1.6 job openings, even with the lower job openings number, for every unemployed person. We do see some evidence of softening in labor market conditions, but overall, you're near a 50-year low in unemployment. Wages, you all will have seen the wage number from late last week, and it's whenever it was, and it's a couple percentage points above what would be consistent with 2% inflation over time. So we do see some softening. We see new labor supply coming in. These are very positive developments, but the labor market is very, very strong. Whereas inflation is running high, well above our goal, and right now we need to be focusing on bringing inflation down. Fortunately, we've been able to do that so far without unemployment going up.
Matt. Hi, Chair Powell. Matthew Boesler with Bloomberg News. So many analysts noted at the time of the March FOMC meeting that at least half of Fed officials' projections did imply or seem to imply that a recession was in their baseline forecast as well, given the strong first quarter GDP tracking estimates. And so I'm just wondering if you could kind of elaborate on, why you're optimistic that a recession can be avoided, given that that's the Fed staff's forecast, possibly also the broader committee's forecast as well, and also, of course, most private sector forecasters.
Yeah, I don't think, I know what's printed in the summary of economic projections and all that. I don't think you can deduce exactly what you said about what participants think, because you don't know what they were thinking for first quarter GDP at that point. They could have been thinking about a fairly low number. Anyway, in any case, I'll just say I continue to think that it's possible that this time is really different. And the reason is there's just so much excess demand, really, in the labor market. It's interesting, we've raised rates by 5 percentage points in 14 months, and the unemployment rate is 3.5%, pretty much where it was, even lower than where it was when we started. So job openings are still very, very high. We see by surveys and much evidence that conditions are cooling gradually, but it really is different. It wasn't supposed to be possible for job openings to decline by as much as they've declined without unemployment going up. Well, that's what we've seen. So there are no promises in this, but it just seems to me that it's possible that we can continue to have a cooling in the labor market without having the big increases in unemployment that have gone with many, prior episodes. Now, that would be against history. I fully appreciate that. That would be against the pattern. But I do think that the situation in the labor market with so much excess demand, yet, wages have been moving down. Wage increases have been moving down, and that's a good sign, down to more sustainable levels. So I think it's still possible. I think the case of avoiding a recession is, in my view, more likely than that of having a recession. But it's not that the case of having a recession is. I don't rule that out either. It's possible that we will have what I hope would be a mild recession.
The committee also noted in March that wage growth was still well above levels that would be consistent with 2% inflation. Do you see that as well? And could you kind of explain, how you come to that judgment?
Sure. So we look at a range of wage measures, and then that's a nominal. And then so you assume wages should be equal to productivity increases plus inflation. And so you can look at the Employment Compensation Index, average hourly earnings, the Atlanta Wage Tracker, compensation per hour, basically those four and many others, and you can look at what they would have to run at over a long period of time for that to be consistent with 2% inflation. They can deviate. Corporate margins can go up and down, and there is a feature of long expansions where they do go down, where labor gets a bigger share toward later in a recession. Later in an expansion. So yeah, and we calculate those, and you have to take the precision with a degree of salt. But I would say that what they will show is that if wages are running at 5%, 3% is closer to where they need to be. Wage increases closer to 3%, roughly, is what it would take to be consistent with inflation over a longer period of time. By the way, I do not think that wages are the principal driver of inflation. You're asking me a very specific question. I think there are many things. I think wages and prices tend to move together, and it's very hard to say what's causing what. But I've never said that wages are really the principal driver, because I don't think that's really right.
Great. Chris Rugaber at Associated Press. Well, you mentioned profit margins. Those have expanded, did expand sharply during this inflationary period. And while there are some signs that they are starting to decline, many economists note they haven't fallen as much as might be expected, given that we're seeing at least some pullback among consumer spending. So speaking of causes of inflation, do you see expanded profit margins as a driver of higher prices? And if so, would you expect them to narrow soon and contribute to reduced inflation in the coming months?
So higher profits and higher margins are what happens when you have an imbalance between supply and demand. Too much demand, not enough supply. And we've been in a situation in many parts of the economy where supply has been fixed or not flexible enough. And so, you know, the way the market clears is through higher prices. So to get, I think as goods pipelines have gotten, you know, back to normal so that we don't have the long waits and the shortages and that kind of thing, I think you will see inflation come down, and you'll see corporate margins coming down as a result of a return of full competition where there's enough supply to meet demand, and then you're really back to full competition. That would be the dynamic I would expect.
Michael McKee from Bloomberg Radio and Television. Can you tell us something about what your policy reaction function is, your policy framework is going forward? When you look at the economy at the next meeting, are you looking at incoming data, which is by definition backward looking? Are you going to be forecasting what you think is going to happen? Are you ruling out the rate cuts that the market has priced in?
I didn't catch the last part. Ruling?
Markets have priced in rate cuts by the end of the year. Do you rule that out?
Okay, I got it. So what are we looking at? I mean, we look at a combination of data and forecasts. Of course, the whole idea is to create a good forecast based on what you see in the data. So we're always looking at both, you know, and it will, of course, it'll be the obvious things. It'll be readings on inflation. It'll be readings on wages, on economic growth, on the labor market, and all of those many things. I think a particular focus for us going now over the past 6-7 weeks now and going forward is going to be what's happening with credit tightening. Are small and medium-sized banks tightening credit standards, and is that having an effect on loans, on lending? And you know, so we can begin to assess how that fits in with monetary policy. That'll be an important thing. I just, you know, we'll be looking at everything. It's, again, I would just point out, we've raised rates by 5 percentage points. We are shrinking the balance sheet. And now we have credit conditions tightening, not just in the normal way, but perhaps a little bit more due to what's happened. And we have to factor all of that in and make our assessment of, you know, of whether our policy stance is sufficiently restrictive. And we have to do that in a world where policy works with long and variable lags. So this is challenging, but you know, we will make our best assessment, and that's what we'll be thinking.
What about the idea of rate cuts?
Yeah, so we on the committee have a view that inflation is going to come down, not so quickly, but it'll take some time. And in that world, if that forecast is broadly right, it would not be appropriate and to cut rates, and we won't cut rates. If you have a different forecast, and you know, markets have been from time to time pricing in, you know, quite rapid reductions in inflation. You know, we'd factor that in, but that's not our forecast. And of course, the history of the last 2 years has been very much that inflation moves down. Particularly now, if you look at non-housing services. It really hasn't moved much, and it's quite stable. And you know, so we think we'll have to demand will have to weaken a little bit, and labor market conditions may have to soften a bit more to begin to see progress there. And again, in that world, it wouldn't be appropriate for us to cut rates.
Courtney. Courtney Brown from Axios. I'm curious how you view the role of the overnight reverse repo facility in the context of the current banking stress. Do you think it's contributing to the stress by making it more attractive for money market funds to compete with banks for deposits? And did the committee discuss any changes to the structure of the facility, or do you see that being put on the table in the future? Thanks.
Sure. So we looked at that very carefully, as you would imagine, and it's really not contributing. We don't think now. It hasn't actually been growing. It moved up, moved down, and then moved back up to where it was. What happened in the when there were the big deposit flows, which by the way have really stabilized now. What happened was institutional investors took their uninsured deposits and put them in government money market funds, which bought paper from the Federal Home Loan banks and things like that. Over the course of maybe the last year, retail investors had been gradually, as they do in every tightening cycle, they've been gradually moving their deposits into higher yielding places such as CDs and other things, including money market funds. So that's a gradual process that is quite natural and happens during a tightening cycle. What was unusual really was the institutional investors moving their uninsured deposits and spreading them around and things like that. But it doesn't seem to have had any effect overall on the overnight repo facility. That is really there to help us keep rates where they're supposed to be, and it's serving that purpose very well.
Okay, Sarah.
Sarah Ewald-Weiss, CBS News. I want to go back to the debt ceiling for a moment. I know you talked about that in terms of fiscal policy, but can you just speak towards what the impact of a default would mean for Americans across the country, the markets, and borrowing?
Yeah, I would just say it's. I don't really think we should be. We shouldn't even be talking about a world in which the U.S. doesn't pay its bills. It just shouldn't be a thing. And again, I would just say we don't. No one should assume that the Fed can really protect the economy and the financial system and our reputation globally from the damage that such an event might inflict.
Scott.
Thanks, Mr. Chairman. Scott Horsley from NPR. In his report last week, Vice Chair Barr identified a couple of the factors that he thought contributed to the regulatory or the supervisory lapses at Silicon Valley Bank. A policy change in 2019 to exempt all but the biggest banks from strict scrutiny, and also what he called a sort of cultural shift towards less aggressive oversight. You were here in 2019. Do you share that view, and what would it take to get the stronger oversight that you and he said in your release would be necessary?
So I didn't take part in creating the report or doing the work, but I have read it, of course, and I find it persuasive. I mean, I would say it this way. A large bank, not a very large bank, a large bank failed quite suddenly and unexpectedly in a way that threatened to spread contagion into the financial system. I think the only thing that I'm really focused on is to understand what went wrong, what happened, and identify what we need to do to address that. Some of that may just have been technology evolving. We have to keep up with all that, but some of it may be our policies and supervisory and regulatory, whatever. Well, what our job is now is identify those things and implement them, and that's kind of the only thing I care about and I feel like I am accountable for doing everything I can to make sure that happens.
Go to Evan.
Thank you. Evan Reiser with MNI Market News. Chair Powell, are we in the early stage or nearing the end stage of the banking turmoil among regional banks? And secondly, do you still have a bias to tighten rates? Is that what the statement is saying?
So, I guess I would say it this way. There were three large banks, really, from the very beginning, that were at the heart of the stress that we saw in early March, the severe period of stress. Those have now all been resolved, and all the depositors have been protected. I think that the resolution and sale of First Republic kind of draws a line under that period of, is an important step toward drawing a line under that period of severe stress, okay? I also think we are very focused on what's happening with credit availability, particularly, with what you saw in the beige book, and you will see in the SLOOS, is small and medium-sized banks who are feeling that they need to tighten credit standards, build liquidity. What's going to be the macroeconomic effect of that? More broadly, we will continue to very carefully monitor what's going on in the banking system, and we'll factor that assessment into our decisions in an important way going forward.
Okay, Greg.
Thank you, Fed Chairman. Greg Robb from MarketWatch. I just wondered if you've done any reflection on your own actions during this crisis and leading up to it over the last, since you've been Fed Chairman. I think I've heard you say a couple of times that you deferred to the Vice Chair for supervision. Do you think that was the right way to go about this? And yeah, comments on that. Thank you.
Sure. So let me say, first of all, I've been chair of the board for 5+ years now, and I fully recognize that we made mistakes. I think we've learned some new things as well, and we need to do better. And as I mentioned, I thought the report was unflinching and appropriately so. I welcome it, and I agree with and will support those recommendations. And I do feel that I'm personally accountable to do what I can to foster measures that will address the problems. So on the Vice Chair for supervision, the place to start is the statutory role, which is quite unusual. The Vice Chair, it says, shall develop policy recommendations for the board regarding supervision and regulation of depository institution companies, and shall oversee the supervision and regulation of such firms. So this is Congress establishing a 4-year term for someone else on the board, not the chair, as Vice Chair for supervision, who really gets to set the agenda for supervision and regulation for the Board of Governors. Congress wanted that person to have political accountability for developing that agenda. So the way it works, the way it has worked in practice for me is I've had a good working relationship. I give my counsel, my input privately, and I offer that, and I have good conversations, and I try to contribute constructively. I respect the authority that Congress has deferred on that person, including working with Vice Chair Barr and his predecessor. And I think that's the way it's supposed to work, and that's appropriate. I believe that's what the law requires, and but it isn't. I wouldn't say it's a matter of complete deference. It's more, I have a role in presenting my views and having an intelligent discussion about what's going on and why, and that's my input. But ultimately, that person does get to set the agenda and gets to take things to the Board of Governors, and really in supervision has sole authority over supervision.
Just wondered if you had any regrets, or was there anything that, decisions that maybe you regret now in light of what's happened?
I've had a few. Sure. I mean, who doesn't look back and think that you could have done things differently? But honestly, you don't get to do that. Again, my focus is on control the controllable. As one of my great mentors used to always say, control the controllable. What we control now is make a fair assessment, learn the right lessons, figure out what the fixes are, and implement them. And I think that Vice Chair Barr's report is an excellent first step in that, but we've got to follow through.
Great. Thank you.
Hi there, Megan Casala with Barron's. Did the possibility of pausing at this meeting come up at all, and how seriously was that considered? I'm curious if you can give us any color as to whether there were any initial concerns about raising rates again, or what those discussions entailed.
So support for the 25 basis point rate increase was very strong across the board. I would say there are a number of people, and you'll see this in the minutes. I don't want to try to do the head count in real time, but people did talk about pausing, but not so much at this meeting. There's a sense that we're much closer to the end of this than to the beginning. That, as I mentioned, if you add up all the tightening that's going on through various channels, we feel like we're getting close or maybe even there. But that, again, that's going to be an ongoing assessment, and we're going to be looking at those factors that we listed and to determine whether there's more to do.
I'm curious, too, how to interpret that and the changes to the statement. Is the bar higher now to raise rates at the next meeting, or would a strong jobs report or inflation print be enough to push the Fed to tighten again?
I don't want to. I couldn't really say. I just think I think we've moved a long way fairly quickly, and I think we can afford to look at the data and make a careful assessment.
And we'll go to Nancy for the last question.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. You mentioned a few times about the lessons you learned from the banking crisis, that you would learn the right lessons. What are those lessons?
Well, I just would start with something that's changed, really, which is the run on Silicon Valley Bank was out of keeping with the speed of runs through history. And that now needs to be reflected in some way in regulation and in supervision. We know now that we know it's possible. I think no one thought that was possible. No one had. I'm not aware of anybody thinking that this could happen quite so quickly. So I think that that will play through. It will be up to Vice Chair Barr to really take the lead in designing the ways to address that. But I think that's one thing. I guess I would just say that then that we're going to revisit. It's pretty clear to me anyway. It's clear that we need to strengthen both supervision and regulations for banks of this size, and I'm thinking that we're on track to do that as well.
Can you be any more specific on stress testing or looking at banks that have specific concentrations in certain parts of the economy?
Yeah, that's what Vice Chair Barr's role really is, and he'll take the lead on that.
Okay, thank you.
Thank you.
All right, that was Fed Chair Jay Powell, of course, after the decision to raise rates by another 25 basis points, the 10th such move in a little more than a year. And maybe most importantly of all, as you heard the Fed chair, non-committal on whether, in fact, it was 10 and that's it. He said a decision on a pause was not made today, and I'm quoting. He did acknowledge the change in language, though, essentially substituting determining for anticipating when it comes to future rate hikes. Also said of the banking system, conditions have broadly improved. He called it sound and resilient. And that, of course, despite the fact that we've had 3 bank failures since March. He did note tightening in credit, underscored how tight the labor market remains. As for stocks, there's your live picture there. We're at the lows of the day for stocks. It's taken a bit of a moment for all of this to filter into the market. Stocks seem to be moving lower on the comment that the Fed chair made about 10 minutes or so ago, where in their own forecast, it is not for inflation to come down all of that quickly. Quote, in that world, said Fed Chair Jay Powell, he doesn't see rate cuts coming. The market, of course, is telling a bit of a different story. And we'll get into all of this with a great panel ahead. Liz Young is with us today. Jeffrey Gundlach, as he has been for every Fed decision now, is joining in just a matter of moments. The Double Line CEO with us exclusively. Liz Ann Saunders is here as well. I will turn to Liz Young. Steve Leisman called this
All right, good people. I put this on to make sure because it's that way I'll know it's on mute. See that I learned something. All right, let's talk about a few things. And you guys saw it was a roller coaster. The markets did a roller coaster ride as it normally does. Let's see where big tech is. Let's see where this is. As we could see, the market tanked, of course, while he was talking. As you can see, the main 3 indices. Sorry, good people. Look, we could see that the market tanked while he was talking. He actually, even Bitcoin went down while he was talking. It's crazy. Okay. So, I mean, they know they already know, like, the longer he talks, the the longer it goes down. Let me go over some key things right now, and then we'll go from there, right? Number one, thank you guys for hitting the like button. Really appreciate you guys for hanging out. I try to keep you guys, up on everything that's happened. So, yeah, just rip the Band-Aid off. I hear you. Uncle Larry, when's a good time to sell cryptos? You know what? I want you to right now, I'm just telling you, this is just for me. I'm not selling any crypto right now. I'm just DCAing. I'm accumulating because it's accumulation phase. I'm not worried about the ebbs and flows of this year because we're in the accumulation phase. I want you to Google the 4 phases of cryptos. Matter of fact, I took a picture of that the other day, and I want you guys to really start looking at, try to find out where we are in crypto. That way you can make a short-term or a long-term trade. Look at that, good people. You see there where it says accumulating phase? We're in the accumulation phase of crypto. There's going to be ebbs and flows in the accumulation phase, right? And then we got the markup phase. The markup phase, I believe will happen. We're talking about a 400-day cycle, right? And so we're not, the markup phase is not going to start this year. This year is all about accumulating. So I don't mind the ebbs and flows because no one knows where the top is, no one knows where the bottom is. And then when we get up to the markup stage and when we get into the halving, that's where I believe the markup stage, it will start to go up. All right. Sorry, I'm trying to answer a lot of questions. Okay. So the Fed says that he will take a data dependent approach when it comes to if he's going to continue to raise interest rate hikes. He also stressed that the labor market remains tight. Unemployment rates remains very high in March. He also said wage growth has shown signs of easing. Inflation has moderated since the middle of last year. But he also said inflation wasn't coming down soon enough. And that's when all of the indices kind of sold off right there when he was asked about the rate hikes. And so he answered it with talking about inflation not coming down as quick as he would like it to. OK, so all right, you got it. Hey, I don't know if that was for me. Thanks, Larry, for holding this live chat. Hey, I appreciate you guys. Yep. Hey, I'm staying with you guys, man. I'm staying with you guys. But I'm going to tell you, when that final leg comes down, I don't care if I got 3. You guys, the ones that haven't tapped out, so you guys could see, right? You guys could see right on my page. I have, 565, 66, 60, almost 600,000 subscribers. I'm sorry. I got almost 600,000 subscribers, right? And across the board on YouTube is this way. A lot of them have just tapped out. They're sick of looking at the red. So they're just tapped out, right? And so they're still subscribed and they'll be back during the next bull market. But the truth be told, you guys are the wiser. You guys will be way more prepared for the next bull market than these guys are. They will actually miss the bottom. Google it. The bottom of the market usually lasts only 11 days. And if you're not checking on your money or your future, then, the rest of them are out there watching cat videos, right? When you're trying to figure out how can I build generational wealth, you will be more prepared and better positioned than the ones that have tapped out. It's a prime example of what they call dumb money. And when things have rose by 25, 30, 45%, and then they hear that we're in another bull run, that's when they're going to come back in. But you and I will start buying when it's hard. That's what Warren Buffett says. Be brave when others are be greedy when others are fearful, right? And vice versa. Be fearful when others are greedy. When others are greedy is when the market is at the top and everything is frothy and everything's ran back up. But when it comes down, that's the time to do what we are doing, okay? And if you want to learn more about that, top link below. Stock up you. Come learn even more. Earn even more. Okay, good people? Hey, listen, we will be live in at 7 p.m. Okay, 7 p.m. we will be live with the guys. Okay, we got Stocks with Josh should have 3 times the subscribers that he has. He is a charting expert. He's better than anybody I see on television. He really is. And I'm just calling it the way it is. And not because of who he is. And we launched his page right here. I've been knowing him for years, and he just is. And I dare you to find a charter that's more accurate than he is. So I want you guys to join us tonight, okay, as we talk about everything, okay? So we're going to leave it right there, good people. I will continue to work to help you, your family, your kids, and your kids' kids to gain generational wealth. I believe we get one shot. Now, there's going to be other times to make money, but I believe in my heart of hearts that the greatest transfer of wealth in the history of the world in your lifetime and my lifetime is happening right now. We have to be positioned, all right? So we're going to continue to do what we can do. I'm going to give you guys everything that I have. And I'll be honest with you, you guys know that YouTube pays me on commercials. Well, I'm making 1/4 of what I used to make. And I'm going, you know what? I think I need to go start driving Uber again. You know what? I'm just be honest with you. That's what I did. That's what I did. So I can have money to invest. That's what I did in 2018. And so I'm just telling you, steady is the way. I'm the real deal as far as not having a college, I don't have a 4-year degree in finance. I don't. I'm from the dirt. I'm from you. I'm from you and me, right? And don't let the soup fool you, okay? Don't let it fool you. This suit cost me actually I got it on sale for $199. I don't own any $1,500 suits. My money is my money is making money. And I just want you guys I'm screaming it from the mountaintops. Like the longer this goes on and the closer we get to the bottom, the louder I'm going to scream. Guys, now is the time to be greedy. Now's the time to be greedy. When everybody else has tapped out, I will stand on a rock alone and go, now's the time to be greedy. But when it gets frothy again, the average bull market, like 3 years? When it gets frothy again, I'll also be the first one to say, hey guys, time to take some profits, okay? All right, come join us tonight. I am going live all day today, all right? Thank you guys. Love you guys. We'll see you tonight.